Please note that the information on Retire Vivid referenced in this video is accurate as of February 5th, 2025. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And we were just talking about this. Today's episode is on required minimum distribution, specifically the planning when it comes to this. Because, I mean, like I said, you and I were talking about it. You know, where's people's wealth at? It's in their homes, usually, right? And their IRA 401ks. But, I mean, a lot of our clients, Tommy, you know, the way they were taught is feed these plans and get that tax deduction going in, because when you retire, what's supposed to happen?
Going to a lower tax bracket.
But yeah, you're supposed to go to a lower tax bracket, right? But here's the deal. What if you were a good saver? You could pop into those higher tax years when you're retired.
Yeah, I mean, it doesn't always happen that you're in a lower tax bracket. And marginally, you have your 10, 12, and then your 22, 24. There's not much difference between the 10 and the 12 or the 22 and the 24. And so what we're looking at is the RMDs, subject to us living long enough to make it there, they are going to happen. Right. And so do we do something about it now, or do we just wait and kind of let it happen when it does?
Well, I mean, a lot of our clients, they go, boy, I wish I met you 10 years ago, because they just weren't getting that information. Again, that's just the way they were taught. The Roth IRA is such a big deal right now. I mean, so we'll talk about planning here in a little bit, but I want to dial into these required minimum distributions, get some questions answered, then we're going to talk about some planning. So, Tommy, what is a required minimum distribution?
Required minimum distribution is an amount, it's a calculation that is required to be taken out of typically your retirement accounts. Most often the pre-tax portion of those, your IRAs, your 401ks, your 403bs, TSPs, the portion of that, they have said you took a tax deduction going in, it has grown for how long it's been in there, and at the age you have to start those, they say here's a percentage you have to take each year, and that percentage grows
the older we
age.
Get.
Yes.
Right. The older we get. Okay. So let's just say you go, you know what? I don't want to take my RMD. The government's pretty nice to you. I'm kidding.
They've gotten a little bit nicer.
They've gotten a little bit nicer. That's
yes,
true.
They used to be, prior to the passing of the Secure Act, the penalty was 50%. Now, if you miss that RMD, the penalty is 25%. You correct it in what they determine to be a timely manner, that can go down to 10%. But in any shape, it's extra taxes or extra penalty paid on that amount. So plan for it and get it taken care of.
Yeah, they're real nice. So the point is, take your RMD, because we don't want you getting penalized. I mean, we kind of already talked about this, but what accounts specifically are tied to the RMDs? I mean, there's some caveats if you're still working and contributing to a 401k, but again, Tommy, many people are maybe contributing to a different plan, whether it's a 401k, a 403b, a 401a, a 457, TSP if you're a federal employee. I mean, those accounts can be subject to the RMD.
Yeah, it's most often you will look at your account and see if you are doing the pre-tax or the after-tax and Roth. So RMDs tend to apply to the pre-tax portion of those accounts.
Well, that leads my next question. Are Roth subject to an RMD, the Roth IRA?
Generally, no.
Generally,
unless
it's not just a no?
It's not a no. If you own it outright, it is a no. If you have inherited it, they may apply.
That was pretty well said. Okay. Well, the point is, make sure you talk to a professional in terms of how that Roth is. Are you the one that made those contributions, right? So then the answer would be no. But if you inherited it, it could be yes, right? But the beauty with it, though, is it can. Again, I can't be resolute here in terms of a concrete answer, because there's rules with Roth IRAs in terms of is it a tax-free vehicle for you or not?
Correct.
Okay. Well, let's stay on inherited IRAs, and so they changed the law on us. With the original Secure Act, is an inherited IRA or inherited beneficiary IRA subject to RMDs?
Yeah, significant changes were made, and these are the traditional or the pre-tax assets. But there are kind of carve-outs for a select few beneficiaries, but in general, prior to the Secure Act passing, so an individual who passed away in 2019 or earlier and you inherited the account, you had the lifetime stretch option where you could take an annual RMD.
Right.
Starting in 2020, and if the person passed, January 1st, 2020 or later, then it tends to fall under the 10-year rule.
The 10-year rule where it has to be depleted over 10 years.
The account has to be depleted in 10 years, yep.
Right. I mean, it's important that our viewers make sure they understand that, because, they could potentially be grandfathered in if they received that inheritance prior to that year.
Yep.
So the stretch IRA, Tommy, was a big deal. I mean, it was awesome. I mean, it was a great way to stretch, create generational wealth, but of course they had to change that. Okay, so who are designated beneficiaries when it comes to this? Yeah,
so what they consider eligible designated beneficiaries are those who do not have to use the 10-year rule for inherited accounts where the decedent passed 2020 or later. So those individuals are the surviving spouse, minor children up to the age of majority, disabled, chronically ill, or individuals no more than 10 years younger. So that could be a sibling that's a couple of years younger or friend similar age. Do not have or have options outside of the 10-year withdrawal window.
Sure. Well, you know what? Let's also talk about how the RMD is calculated. I mean, let's just simplify it for people. So the year that you attain, again, it's not that where, for example, it used to be 70 and a half, right? And so you had until April 1st the following year to take a required minimum distribution. I mean, but that was a bad deal because you could potentially have to take 2 out, which could then pop you into a higher tax bracket, which is what we don't want. But now it's the year that you turn that age in terms of a required minimum distribution. How much do we have to take out?
They have a calculation table out there. The percentage grows each year, but your first one at 73 is about 3.77%.
Yeah.
75 is just over 4%. It gets close to 5% at 80 and close to 8% at 90. So that percentage increases each year.
Yep.
And if your account is invested or it's growing, that's where you tend to get a higher percentage on a larger dollar amount. That's where that RMD kind of time bomb can kick in.
And that's exactly right. And that's what we're looking for, because again, the first RMD, when people have to take it out, it's not, I mean, it's under 4%. I mean, it doesn't sound that bad. But the older we get, that percent goes up, like you mentioned. And hopefully your accounts better be growing, right? Which then becomes that tax bomb. And again, that's where planning, we'll talk about that as we move through the episode, but that's important. Okay, let's talk about this. Can I take more than the required minimum distribution amount that I'm forced to take?
Well, you said it right there. That is the required minimum distribution. So that's the minimum amount you have to take.
Yep.
You do have access to your full account balance if you would like it.
Yeah.
But it is not something where you can take more in 1 year and apply it to your RMD for the following year. The RMD is an annual requirement. If you take more, it still resets and there's a new RMD for the following year.
That's right. And now, one thing that we do talk about with this is the required minimum distribution. So that required minimum that you have to take out, that can't be converted to a Roth, period. I mean, that's why we try to catch people prior to that age to do that pre-planning, right? But you still could do Roth conversions after the fact, but you have to take that required minimum distribution first.
Yeah, and we'll get into options later if you want to kind of minimize the impact of RMDs, but you have a qualified charitable distribution available to you to minimize the income.
That's a fun thing, yeah.
The income associated with your RMD. But yes, the RMD has to come out of that pre-tax account. It cannot go into a Roth. It could be reinvested into a non-qualified account. But cannot stay in the tax-deferred accounts.
Cannot stay in tax. Okay, well, now let's talk about taxes. Again, this question comes up as well. We are paying tax on this required minimum distribution. It depends on your tax situation, but most of the time the answer is yes. But it's taxed as ordinary income when it comes to the required minimum distribution.
If you are taking it and not doing a charitable distribution, for instance, that amount will be fully reportable. You calculate it at your own tax rate and determine your tax liability on that amount.
That's right. That's right. Now, in the last one, again, I mean, these are all Q&As. I mean, a lot of questions that clients ask us. And so we wanted to bring these questions right away when it comes to this, to help you understand the required minimum distributions. But again, I just mentioned it, right? So when you're that age and that required minimum you have to take, it can't go Roth, right? So what are your options? You already mentioned it. You could gift it, you stick it in the bank, or what do most people do, Tommy?
Reinvest it.
They reinvest it, right? And that goes into a brokerage account, but then that caused that windshield wiper effect, right? Capital gains, dividends, you name it. You know, when you make money, you pay taxes. You make money, you pay taxes.
Yeah, it's no longer a tax deferred asset. It's a taxable asset, and you create that annual effect.
That's right. That's right. Okay, so we just talked about the Q&A. A lot of questions that people want to have. The next thing we're going to hit on is the planning of the required minimum distribution. So we're setting the stage here. So make sure you stay with us. Back to the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Okay, welcome back to Retire Vivid. Okay, so we just talked about the required minimum distributions, a lot of questions that people have, but let's put some dollars behind it. So Tommy, let's just say we got somebody that's turning 73 and then they got to take an RMD. Walk them through it.
First RMD at 73 is rounded to 3.77%. So on $1 million, that amount is $37,735.85.
In change. Right, in change. Now, if it's $2 million, I mean, you simply just double it. I mean, the math is the same. The percent, right, is what we're looking at. But on a $2 million, you're at $75,000 in change. And then if you're at $500,000, it's $18,000 for the year. So again, I mean, we work with people across the board. It just depends on the size of those IRAs. Now, here's a question. So let's say you have 3 or 4 different IRAs, Tommy. Do you have to take an RMD from every one of those accounts, or do you pull from one? How do you do it?
Yeah, you want to look at your account types. So IRAs, specifically IRAs, can be grouped together. A lot of times you get into an IRA and a 401k, maybe a 403b. If they are different tax types, then you would want to satisfy them individually.
Okay.
So just sit down, figure out what types of accounts you have. Are they all IRAs? Then it can be taken out of one account. If you have different things in there, you want to satisfy them individually.
You want to, yep, absolutely. I mean, here's the deal though. The whole purpose of what we're, and you all know this. I mean, for those of you that have been watching this for some time, we want to be tax smart, right? One of my big missions is how do I save people money in taxes? That's what we're trying to do here. So how do we become tax smart with minimizing required minimum distributions? So one of the things that we do here with our company, especially with our clients, is we do what we call it a mock tax return, which is where we look into the future, because so many times, right? Well, Tommy, here's another question we didn't talk about. So let's just say that you want to do a Roth conversion. Okay, I mean, what's the timeline in order to do a Roth conversion?
Roth conversion is calendar year. So it happens in the calendar year. You do the Roth conversion January 1st to December 31st.
And so that's where I'm getting at, because when we're planning and you want to do a conversion, it may already be too late because you should have done it before that end of that calendar year. And so taking a look at the RMDs in terms of, okay, do we pre-plan with it? Do we do pre-RMDs? I mean, let's talk about these examples and then we'll dive in a little bit more.
So, I mean, if you're out there looking at your RMDs, we touched on the percentages, but starts a little under 4%. At 80, it's a little over, right around 5%, and then at 90, it's right around 8%. And so depending what kind of assumptions you're using how your account may be invested. Are you looking at growing 5, 6, 7% a year? If you have those assumptions in there, then that RMD just continues to get bigger until the percentage you are required to withdraw kind of outgrows or is larger than the amount the account grows. And so this is why we talk about planning. You're never going to get it exactly right, but at least you have an idea of where you're going and can you be tax smart now.
I like the visual aid of things and really showcasing how do we do it here. Take a look at this example. This is big, so make sure you stay with us on this. Okay, so here we got a married couple. We have with $275,000 in combined non-portfolio taxable income. They've got they're taking the standard deduction right now with their taxes, and also they have $2.5 million in combined tax deferred accounts at age 59 and a half. Okay, the annual growth rate 6%. I think that's fair. I think that's conservative enough. I think that's okay. Take a look at this, folks. Okay, so you can see they've crossed over the 10 and 12% tax bracket. They've crossed the 22. They're into 24. But look what happens down the road if they did not do any planning with the required minimum distributions. Tommy, look at this. Boom. The tax bomb just hit, and look what it just did. It popped them not just to the top of the 24, they just crossed 2 more tiers.
It's important when you are tax planning is to look at how the tax brackets are bunched.
Right.
So 10 and 12 are close together. 22 and 24, those are close together. And then 32, 35 and above, those are close together. But between them, you go from 12 to 22, that's 10% difference. You go from 24 to 32, that's an 8% difference. So
right.
That when we talk about planning, it is looking at what marginal rate are we paying right now? Is there an opportunity in the middle to do some of the pre-RMD or the pre-distributions when we're looking at Roth conversions? And then where are we going eventually?
Eventually, that's right, our tax landscape. And so, folks, I want to be clear. I mean, if you have this going on, you got a good problem, okay? I mean, this isn't a bad thing at all.
It is not. It is not a bad thing.
Well, from a tax perspective, it is. But
from a tax perspective, can you be smarter? But it is not a bad thing to have, an RMD that you're going to be forced to take.
That's right.
In the future.
Yeah, to be smarter with it. Okay. Well, let's talk about that. Okay, so this is for a couple that did no pre-planning. Now let's say that they did. So here, what they're going to do. I mean, this is a very simple concept. In this example, let's go back to where they were with their income. And so you can see that coming in. But then they just did some Roth conversions, for example. And what did they do? They did not cross that tax bracket because, again, I don't want to pay more tax. I don't want to pop into that higher tax bracket and pay unnecessary tax. So they just got to the top of the tier. What are they doing? They're bracket bumping. And look what we did. Then the RMDs kicked in. We kept them in the same bracket throughout those years up until a certain point, but by that point, they're age 95.
When you are looking at planning, it's important if you have the window while you're filing jointly, because again, these tax brackets later in life, if we do lose one of the spouses, if you're filing at a single rate, your income levels are much lower, and that RMD is still the same if you have taken those assets at your own. So, if you have the time, if you have the opportunity in tax brackets, take advantage of it.
I mean, Tommy, this is such valuable information that we're giving people, but I mean, a lot of people have questions when it comes to their own retirement plan or maybe their tax situation, and that's also why we offer that 15-minute retirement review.
Right, yeah. I mean, most people understand they have to do something with their investments or how they're going to, pick what they're invested in, what they want their account to do. But taxes are sometimes that forgotten piece on the back end that it's going to happen at some point. And so that's where if we can answer a quick question or give that guidance in those 15-minute calls.
That's right. That's right. So we encourage all of you to take advantage of that. Coming up, we're going to talk about a little bit more on Roth conversions, but also another one, and that's a QCD. What is that? More right after the break. Okay, welcome back to Retire Vivid. So we were just talking about the Roth conversion. So Tommy, should we just convert the whole thing? is that what we're trying to say here?
That's probably not the recommendation.
That's not the recommendation.
We've mentioned percentages a couple times,
right.
but a lot of times it's either looking at your tax brackets or
right.
kind of right-sizing your IRA to your income needs.
That's
so
right.
Are we, getting that IRA balance to where you need your 4 to 5% withdrawal rate for income needs?
Yeah.
Then it's, then it may grow in line and provide you your income.
Right.
Look at converting beyond that. But
Yeah, you and I talk a lot about this. I mean, folks, keep in mind, we're just trying to get you thinking about this stuff when it comes to the Roth, because the Roth is such a valuable tool. I mean, if you take a look at here in the state of Iowa, let's talk about state tax. Let's just talk about taxes. For Iowans that are 55 and older, here in the state of Iowa, you pay no state tax on Roth conversions.
Right.
That's a big deal, Tommy.
They eliminated the taxes on your IRA distributions for those 55 and older. So, yeah, that's a savings right off the bat.
And also, tax rates did drop. We'll see what happens moving forward. But, this is kind of that, I don't want to know if I want to use the word a perfect storm, but, depending on the situation. But, it is getting so attractive right now when it comes to Roth conversions. But so many times, to what you just said, a lot of people don't know how much to convert. Again, we're not telling you to go take $100,000 and convert it. Don't do that. You talk to a professional. Specifically, you talk to a tax professional about this stuff. All we're trying to do is fill that bucket up, right? Fill that tax bracket and don't pop into another tax bracket.
Right, and we mentioned earlier, just looking at where the marginal rates have the bigger gaps. So 12 to 22,
right.
24 to 32, there's bigger gaps in there. So
Yep.
Are there opportunities to fill the brackets that are close together?
Well, let's talk about another one, and let's end on this. Let's talk about QCDs. What's a QCD?
It's a qualified charitable distribution. So for those who are charitably inclined, want to give money, the QCD allows the money to come directly from an IRA to a charitable institution.
Okay.
And it's essentially not reportable as taxable income.
Okay.
It'll still show there, but you don't include it as an addition to income or a deduction. Is just not shown as taxable income.
That's a big piece you just said there. Folks, I hope you picked what he said. Meaning that if you do a QCD where you take money from a traditional IRA to a charitable organization, I'm just recapping what you said, you pay no tax. And it satisfies your RMD. But what age can you start doing this?
They are allowed at 70 and a half or older. So
That's right.
Even prior to RMDs, if you are, using that money to give charitable donations, QCDs allow that to be done in a more efficient manner.
Let's give a couple scenarios, Tommy. Walk our viewers through it.
First scenario, individuals have $50,000 of non-IRA income. They have an RMD of $100,000 and they want to donate 50 of that to a charity.
Okay.
So you add those together, you have $150,000 of pre-tax income. We are assuming that the $50,000 donation in this example is their only deduction. So they deduct 50 from the 150, have $100,000 of taxable income right there, around or just under $17,000 of estimated taxes on that amount.
If you think about that, that's not too bad. Again, you're taking an RMD of $100,000 and then also donating that $50,000 in cash. Not bad. Okay, let's move on to another scenario.
Yeah, so how do you make that more efficient? So in this example, you have that same $100,000 RMD requirement, but $50,000 is taken to you, $50,000 sent as a QCD,
okay,
plus that other $50,000 of income. You have the QCD not reportable as income. You have $100,000 of pre-tax income. Use your standard deduction of $83,000 of taxable income, and pay in just over $13,000 in estimated Fed taxes.
That's still not bad. In terms of what you're trying to accomplish with the money.
It shows it saves you there, just under $4,000 of tax savings by doing it in a more efficient manner.
There are a lot of ways that you can handle this. Folks, again, this is just the tip of the iceberg. We go through so much in terms of your taxes, your wealth, your financial well-being, you name it. Tommy, I encourage everybody to go to our YouTube channel so you can take a look at past episodes, some things that we've talked about in the past. and really dial into what makes sense for them.
Right. Today was all about RMDs, a little bit of tax planning. We cover a broad range of topics in the show. We put a lot of past episodes out on our YouTube channel. If you'd like to stay up to date, be sure to like and subscribe.
Can they hit that notification bell?
Hit the notification button if they want to
They
stay
can
up
hit
to
the
date.
notification bell?
That's right.
Hit the notification bell, folks. I mean, stay up to date with everything Vivid. But unfortunately, that's all the time we have for today. So again, thank you for watching. Thank you for making this show possible. And please DVR Retire Vivid so you never, ever, ever miss an episode of the show. We'll catch you next time right here on Retire Vivid.
This segment is brought to you by Vivid Tax and Wealth Advisors. Learn more at retirevivid.com and make retirement vivid. Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.